I'd say, although we don't actively incorporate our macro thoughts into portfolio construction, we're both students of history. We love studying history. And so in our quarterly insights letter, we went back and looked at the last seven Fed cutting cycles going back to 1980. And what we found was that five of the seven previous cutting cycles going back to 1980 were associated with recession. So pretty clear. Rates go down a lot. The Fed tries to cut rates aggressively to ward off economic weakness, and the entire curve shifts down. There's two of the seven cases the Fed cut not associated with the recession. One was in the mid 1980s after the very high inflation and growth of the early 1980s, which isn't really an applicable environment to today. The other cutting cycle that took place, which was the last so-called soft landing, was in the mid 1990s. The Fed actually cut rates during that cycle, but it was very modest, approximately 100 basis points over a couple year period. And of the seven cutting cycles since 1980, that was the one cutting cycle where interest rates 12 months after the first cut, rates actually rose, which is what's happened here. I think most people were surprised to see the Fed, after the Fed cut 50, the entire curve has shifted up, and using the 5 and 10 year as a barometer, those rates are up approximately 50 basis points since the Fed cut. So that is actually analogous to what happened in the mid 1980s, which was, a soft landing. The economy remained strong, growth remained strong, and rates actually rose.